Welcome back to the channel. So yesterday I made a suggestion about going long Alibaba. It didn't take long for that trade to be nullified as the stock has gapped down even past our signal. Fortunately for the way I set up that trade, it's not that big of a loss. And I want to show you how that trade was set up, and I just want to speak a little bit about my experience in trading. So I've been trading now full-time for the last couple of years. And when I say full-time, I mean full-time. I do nothing else for income in my household. My wife doesn't work. She's a stay-at-home mother. I'm the only one that works. All my income is from trading. I sell zero courses, zero memberships, nothing. Every dollar that I make is strictly from trading. And what I've realized going into trading full-time and in general trying to be a successful trader, that minimizing our losses is a single-handedly most important thing that we can do, because in trading, to make significant money, you have to get lucky. It's impossible to know what stock is going to rip like crazy. Nobody knows. The best that we can do, we can take small losses along the way until we hit a home run. That's the biggest thing I've learned while trying to be a successful trader. So we're first going to start off with an example that is currently working, which is MicroStrategy. And I'll make it a little smaller here. So let's see exactly what was happening here. Purple line represents today's date. Blue line represents come expiration, September 18, okay? So with this type of back spread that I like to set up here, when I did get into this trade, I'm reducing, what I am doing, I'm reducing the losses I would take in the event that I'm wrong. I'm giving up the potential to make money if I'm slightly correct, right? Which is pretty much this zone here. Remember, MicroStrategy was trading at $94 when the spread was put on. But I am gaining extra leverage to the upside in the event that the trade does work on, right? Relative to the risk I'm taking if it doesn't work on, okay? So I'm pretty much giving away a small gain or a moderate gain. And in doing so, I'm minimizing my losses and helping accelerate my gains if I'm correct. Now, as we step forward here, you'll see the purple line, which is again the date that's shown right here. It keeps sloping lower and lower. Theta is what would be killing this position. This is a long theta trade, the way it's positioned. So as you see, the longer I hold on to it, the more it will converge to that blue line. Right now, we have quite the separation from it. And the worst part is if the trade falls within this bucket right here. Now you can see how close we have to come to expiration for it to start getting relatively significant. So the max loss here is $12,000. We're pretty much a week out at this point, expiration-wise, right? This is about 20 days from now, and you could see that the max loss at this point is like $4,000, right? If I were to hold it that long. Now you have to understand something, that if price had dropped down to like $87 and we're a week out, I'm not sitting in this trade and betting an idea that we're going to go from $89 to above 120 in 1 week, right? If anything, the bigger risk is that we're likely to maybe just go up to this dead zone and lose money, right? So this trade would be cut off back here somewhere. Let's look at how the Alibaba trade was set up. Well, first of all, so as we've seen, the MicroStrategy trade, it's currently up $8,300. Let's see. So BABA right now, it is down 7%, pretty much since I got in. I got in right at the close yesterday. So this trade is obviously looking horrible for us, right? You know, and the funny thing is I warned in that, I don't want to say warned, but I kind of pointed out how last time we had an earnings failure here. It triggered and then it kind of failed. And we're seeing this happen pretty much again here. Earnings failure, and now again it's failing. It's failing the failing. We're at the lows of yesterday, even though the markets are relatively flattish to greenish. So down 7%, okay? Let's see how the position looks like. So I'm currently down $245 on that trade, right? That's the unrealized P&L. $245. That's the price I'm paying right now for having been wrong on my trade. Now, let's look at what the setup looks like. I have it already loaded up, but this is obviously not a position inside TOS. I just simply loaded in, that way I could visualize it much easier. So this is how it looks like, the position itself. Once again, a back spread. Price is right here, 121. We try getting in a 130 over here. Okay, so same deal. Okay, we're pretty much in this case, we're not even minimizing our losses if we're wrong on the idea, because we actually collected a credit for this trade. So if it expires down here, we actually end up profiting 650. But we gave away some level of upside here. Remember, we put this trade on when Baba was at 130. So I'm basically saying at that point that, listen, if Baba sits here, does nothing, or just goes up to 140s, I'm going to lose money on this trade, right? As we pull the dates forward, you can see that purple line sloping down. That if, let's say, a week and a half passes, 2 weeks passes basically, and we're still chilling down here, but the actual loss I'll probably be more likely to take is like $1,600 if there is no movement. The whole idea behind an earnings failure is that we're trying to identify when there is a mismatch in positioning, right? Where we basically say, hey, there's got to be that many more buyers right now because the stock is failing to the upside. And if that's the case, and if we have a thesis that, hey, there's going to be a lot of shorts being trapped right now, we expect an explosive move. With these back spreads, we are trying to capture explosive moves while minimizing the chances of being wrong on it. And the truth is, the win rate is going to be below 50%. Which is why sometimes it's tough for me to make these videos on YouTube and put the content out, because I know that it's more likely than not for the trade to go wrong. Because we're not able to make money simply from being right more than wrong. We make money from having asymmetrical risk reward, which would look like this, especially if we get that explosive move, right? So again, right now we're sitting, so you can see the actual position. It should look exactly as it looks like in TOS. I mean, it's actually flat, the P&L right now. We're at $92, right? So again, this might make you believe this position is super small, this and that. Well, first of all, it is a credit position. It's 15 contracts of 15 and 30. And it's possible to lose $9,200, okay? So this is a position that actually has a max loss of $9,200 if you hold this till the very last second into expiration and it finishes right here and there, which should never happen, by the way, okay? Because again, with an earnings failure, we have this thesis that there's going to be an explosive move the other way because of positioning. If it's not happening, it needs to be cut off way sooner, okay? We shouldn't be sitting around in this position forever. Nike was an earnings failure too, and this is an example where it did not work out, right? It had an earnings failure here that day. It simply went nowhere. This position was cut by me somewhere in this zone here because it wasn't going anywhere. We want to see it move. BSX is an earnings failure that I still have on till today. I've reduced the positions, but this is what we're looking for, right? That the earnings failure happened here and then it just went. This is the type of trade setup we're trying to find. This is the type of trade setup that gets paid by those back spreads. This is where we make, on average, 5, 6, 7 times our risk when we capture a move like this. And we try to minimize our losses on trades that were wrong, which is right now, yes, we are wrong on Baba. I mean, I can't see this trade being a valid trade, right? If we just go by the idea that, hey, the stop is right there. That's a lot for it to come back. So the thesis of the trade is dead. But fortunately, the way it was set up, I'm not paying much of a price for it. As you see here, the unrealized P&L is $80 in this Baba trade. It's bouncing. So either way, I'm probably going to lose a couple $100 on this trade with commissions and all. But that's what I wanted to share with you guys. Again, so there's a big point here where I would say probably the majority of any profitable strategies out there, if you have proper stop losses, you are going to be losing more than you are going to be winning. You cannot get around that, but you have to let your winners run and cut your losers quickly before the losses balloon. Even in this Alibaba trade, I have an option right now to cut it at $200 of a loss, right? or I could kind of let it ride and hope that in the next 2 or 3 weeks it has this massive explosion up, but then I risk it going to a little valley where my losses are way larger. And truth be said, if it's movement today, yeah, it kills my thesis. The buyers are not there. I thought they were. Maybe yesterday was simply a gap fill. Maybe yesterday, because the markets were down so much, investors were simply looking for another spot to hide out in. But that's the video. That's what I wanted to share with you guys here. Again, the fact of trying to find creative ways of minimizing the losses to give yourself opportunities to be lucky, right? That the trade I have right now on MicroStrategy, I had no clue it's going to blow up the way it has blown up right now. But because I'm taking all these bets, I'm following my strategy and finding ways to minimize my losses, I will inevitably hit a trade that has a great return. Now, if you found this video helpful, leave me a like, subscribe for more content such as this one. Other than that, thank you so much for watching. Till next time.